Good morning, everyone. Welcome. We're going to start in just a minute. We're going to wait to let everybody cycle in. We're happy to have you here with us, and we'll get going momentarily. All right. Hello again, everyone. Welcome to LSL's Lease Accounting for Private Companies and Nonprofits Guide to Implementation webinar. We are really glad to have you here with us today. Before we begin, we want to go over just a few quick housekeeping items. This webinar will run 50 minutes, followed by 10 minutes of Q&A. So if you want to ask Gail or Mike a question, enter your question in the Q&A box in your Zoom toolbar. To find your Zoom toolbar, hover your mouse over the top or bottom of your screen and it will pop up. Look for the Q&A icon and put your question in there. This webinar qualifies for 1 hour of CPE credit. We will be running 4 poll questions throughout the webinar. So to receive your CPE credit, you must answer 3 of the 4 polling questions and fill out the short evaluation form that'll be emailed to you by Prolera with the subject line, "Please complete your course evaluation." And look for that in the next 1 to 2 business days. All right, now I'd like to introduce our speakers. Mike Mangold is a CPA and audit and assurance partner at LSL. He has spent more than 25 years serving up CPA knowledge, and his latest professional passion is educating businesses and nonprofits on the latest lease accounting standards. He specializes in audit and attest services for privately held businesses across a variety of industries. His clients range from manufacturers and auto dealerships to service firms, wholesalers, and distributors. Mike also oversees audits of 401k benefit plans and is a peer reviewer for the AICPA peer review program administered by the California Society of Certified Public Accountants. Gail Gray is a CPA and the firm's technology partner. As the lead of our technology consulting team, she continues to be an expert in accounting, financial reporting, and the software solutions finance teams rely on to accomplish those processes. She maintains our partnerships with technology providers to make sure we can support our software customers in the best way possible. For over 20 years, Gail has worked with businesses, nonprofits, accounting firms, governments, and other entity types, providing them best practices, training, guidance, customization, implementation, and support in relevant standards and technology. All righty, those are our presenters, and now I'd like to hand it over to Mike. Take it away, Mike.
All right, thank you, Jill. Good morning, everybody, and thank you for joining us. I'm Mike Mangold, and I'm excited to provide this quick overview of leases for you, and I mean quick. 25 minutes or so is what I'm allotted for here for a topic that I could probably talk for 4 to 8 hours on. I know many of you have probably sat in on 8-hour courses on this, so let's get started. This new lease accounting standard is one of the most significant changes I have seen in my 34 years as a CPA. Pretty bold statement, huh? So the financial statement impact for operating leases is what's significant here, because you're going to record a significant liability for all these previously unreported operating leases, although you will have a corresponding asset, like a fixed asset. So this is similar to how you would have previously been required to report capital leases. So now it's all these operating leases coming up onto the balance sheet. And so why should you care as an audience out there, especially our business owners and accountants? Well, the accounting change is going to take manpower, a lot of thought and training in the next few months to obtain all the proper lease data. And then you can record the journal entries on an ongoing basis and all the activity related to those liabilities and right of use assets that we're putting on the balance sheet. It's going to take a village. You know, it's CPAs out there. This has been around with public companies for a while, and they've seen how it takes a village. It takes a lot of time and effort to get through and know all of the leases. So we're here to help you, but we need to start today, all of us, and get the team involved, not just the accounting department, because you'll find you need the computer department. You probably need the manufacturing operations departments. Everybody needs to get involved and know all the leases that we have and get all the input that's required. And Gail later on will have a lot of helpful ideas on implementing and some of the technology that's available. So let me share the knowledge on the technical accounting side of the standard. It's this standard's called ASC 842. It came out in February of 2016, so it's been a while here. And like I said, the public companies have already had to adopt this on their 2019 financials, and they had to actually restate their 2018 financials, and if they had comparative financials that they typically do. For private companies, though, we have this option where the comparative financial, say we're going to adopt this now for the 2022 calendar year. The 2021 presentation will not have to be changed. We can just leave it as it was, and the footnote will be like the old footnotes, and then we'll have the new footnote explaining what's going on with the new 2022 financial statements. For nonprofits out there with a June 30 year end, you would be looking at this showing up on the financials for the June 30, 2023 financial year end. And that comparative financial option is known as the additional optional transition method, if you're ever researching this, versus what is otherwise known as the modified retrospective approach. So this eliminates all the previous accounting for operating leases that we had in the past and establishes a single model for all lease accounting, where all operating and finance leases are now treated basically the same. It's kind of a good time probably here to kind of contrast the old to the new, just for a quick little reminder. Under the old 840 standard, we had these bright line tests to determine if the lease was a capital lease. And if it was, then it went on the balance sheet. And if it wasn't a capital lease, it just remained in the expenses and had a little footnote there that it was an operating lease for 10 years at X dollars to rent this warehouse. And those bright line tests that I mentioned, that was like you had a transfer of ownership at the end of the lease, or you could buy it for $1 at the end, or you were using it for 75% of its useful life, or the present value of all the payments was in excess of 90% of the fair value of the asset. Well, they've gotten rid of that in 842. Now we have 4 criteria that are similar to those numbers, and one new one actually also. So we have 5 criteria. And they don't use the 75%, 90% anymore. In real life, we will kind of still use those, but the terms are major part of the life or substantially all when we look at present value of 90. So it could be 85%, it's going to be in that ballpark of the 90. And then we have another term called reasonably certain. So that's when you're going to exercise options, or if you're going to purchase it at the end, and when you first enter the lease, are you reasonably certain you're going to do that? Then you treat it a different way. So now we're going to have all these operating leases and the capital leases on the balance sheet, and we're going to have a lot more disclosures. I won't show you a full footnote example, but if we were to show that, it would take up various mini slides here. So it's very comprehensive footnote. It's going to require a lot of detail, and we'll get into that a little bit later. And so just in summary, again, a lessee is going to have a lease liability for all these operating leases on the liability section, and you're going to have a right of use lease asset that'll be amortized. And lessors, this doesn't really affect, 842 doesn't impact them too much. Their accounting is still basically the same. So if you were the lessor of some property, you're going to recognize that lease receivable, and you're going to have a deferred liability account for the inflow of revenues that would occur later. The only thing I'll throw out there that this 842 standard change for lessors is in the sales type leases and direct financing leases, the criteria change there to where you're going to end up with more sales type leases. But as far as the financial impacts, it doesn't have much of an impact at all in this new standard. So now you have to look at your lease or these contracts, and determine if it needs to be recorded under the new pronouncement. So when you look at an operating lease, capital leases, like we said, it kind of stays under those criteria, and you have a capital lease. But that is now known under a new term called a finance lease. So you'll hear me say that now going forward. No longer do we have capital leases, we have finance leases. So under the operating lease area, we're going to have the new term here in the standard is you have a contract, verbal or written, that conveys control, being a key word there, of the right to use an identified asset for a specific period of time. So first you got to decide, okay, yeah, I have this asset, and typically right of use assets are buildings, could have some land, vehicles, forklifts, copiers, coffee machine, all these types of things. Identified asset you have control of, and then control, in order for it to be under the lease standard, says you have the right to the economic benefit of that asset. And then once you know you have that, then you look at another control item is, do you have the right to direct the use? Or if you don't, if that, is either in the arms of the supplier or you as the owner, do you have the right to operate the asset? So for the sake of time, I'm not going to go into some examples now where you have an asset and you have this economic benefit, but maybe we don't have this direct use. But I guess a quick one would be like you're renting a fleet of trucks from some freight company. If you're not renting 5 particular trucks that you kind of control and you drive them the way you want to drive them, or you dictate to the supplier when to drive them, then you're just really renting out or have a contract with a freight company to do freight services, and they can use any number of trucks. They can dictate all the terms and they direct the use. Then you don't have a lease. So that would be an unusual situation. And under the standard, this right of use asset specifically excludes supply contracts, leases of inventory, and land easements. So now we're going to look at the lease term after we've determined that we have this lease. And the lease term is going to be the non-cancelable period that you enter into. Say you have a 10-year lease, but it's also going to include in the calculation if you have option periods to extend the lease. But you only include those options if you are reasonably certain you're going to exercise them. And we'll go through an example of this later. And then it'll also include options to extend or not terminate that is controlled by the lessor. So if you enter into a 5-year lease and the lessor has the option to terminate it, then you would include or exclude that lessor's obligation because that's out of your control. There is a policy election that we can adopt, and that is if the lease is for 12 months or less, it does not have to go up on the balance sheet. And that 12 months or less does have to include those options to extend, or if there's an option to purchase it and you're reasonably certain you're probably going to do those, then no longer is it a month-to-month or 12-month lease. It's probably a longer term lease that needs to be on there. And the FASB considered this, like, okay, everybody's going to go out and write up leases that are just monthly and keep this thing off the balance sheets. And they kind of figured out, nah, that's probably not going to happen in real life because of market conditions. You're at risk if you enter into short-term leases other than related parties. But if you did short-term lease with an outside party, you're at the whim of them increasing the rents quite extensively because maybe there's a demand for the area or something's happening out of your control, and you're going to end up paying a whole lot more money you otherwise would wanted to. And then another option here is the, I want to throw out when I said everybody needs to be involved, operations department may be the ones that know that a contract which has something in it about, like, say the machine is going to be used, if it's used for more than 10,000 hours in the first year, then there's an automatic 3-year renewal on the lease. So the accounting department may not know about that, or even if they knew that term, they might not know if operations actually use the machine for greater than 10,000 hours. So operations needs to let accounting know because there's no paper trail. So that's where you might lose the idea that, oh, we thought we only had a 1-year lease and now all of a sudden we got a 3-year lease. So that's where everybody needs to be involved. And then the term commencement, that's been a question I've gotten in the past where, when does the lease term start? Well, it's not the contract date in the agreement. It may differ because you may enter into a contract that's going to start on September 1st for a warehouse, but the landlord has allowed you to come in there on June 1st, 3 months early, and start putting in the racks and loading inventory so that you're up to speed and ready to go on September 1st. So then your lease actually commences on June 1st. And it may not be charged rent in that period, but we need to spread out the lease expense over that longer period. So then we get into some of the calculations, and we'll have some detailed numbers, as we go on through the slides, but just here in a narrative format, the first thing you do to measure the lease is you look at your lease liability. So you need to look at the present value of the payments, less any incentives, like maybe some landlord incentive where they give you $50,000 to do improvements. So you would add up all the payments, less the incentives, and you're doing all this before you get to asset value, because you got to do the lease liability value first. And When I say payments, that also needs to include non-lease components. So an example of that would be like maybe a lease a car, and you're going to rent that car for $500 a month, but on top of that, there's a service agreement on the car for another $149. So now you're actually paying $649 a month. The auto service agreement is a non-lease component. That could be carved out and not included in the liability. But there is an option in the practical expedience to make our lives easier. We don't need to go through every agreement and start pulling those pieces out. You can elect to just add the two together and get the present value of the total $649 payment in that example. But payments would not include taxes or insurance or CPI increases, or maybe if the rent is based on a percentage of sales, it wouldn't include that because you don't know those future CPI increases or percentage of sales. You don't know what that is when you first enter into the lease. So those are not included in the initial calculation. So we would take these payments times a discount rate. Now here's another great thing in the lease. Everybody goes, okay, discount rate, what do we mean by this? So the standard says it's the implicit rate of the lease. Well, typically you're not going to know that. Vendors aren't too transparent in letting us know that rate, because if we knew that, we might not lease the darn thing because it's a very high rate. So then you would step down to the incremental borrowing rate. Well, that's another tough one to get, because now you got to call up the bank and say, hey, if I you have to look at the terms of the lease. So say it's a 10-year term lease. Okay, I got this asset that's worth, say, $500,000. What would it, banker, what would you charge me in interest to enable me to go out and buy this $500,000 asset over a 10-year term? And banks aren't going to be giving us that number all the time. So another option we have for private companies only is risk-free interest rate. So we can go out and get the T-bill rate for a similar term. So say it's a 10-year lease, then you go get the 10-year T-bill rate, which yesterday was 1.34%, and use that rate. But I'll advise right now, I mean, that's probably what we're all going to do. But in using that low 1.34%, you can probably figure out what I'm going to say is that your liability is going to be much higher than if it was at a 5% rate. So now once we know the lease liability, we then can figure out our asset value. So what is the asset? That's going to be that lease liability plus any payments made outside of the lease term and any direct cost. So I have an example coming up, but just for quick here, the payment made outside the lease term might be this upfront rent. Maybe you had to pay rent on when you first entered into the lease, you paid $10,000. So that $10,000 will get added to the present value of the remaining 9 years of payments that we just previously calculated. And then any direct cost, such as commissions or a payment to your existing tenant that you might pay to get them out of the lease so you can take over that building. But you do not include in this cost item any broker fees, legal fees, or company overhead type of cost that you would internally incur before signing the lease. None of that counts. It's sign the lease and any cost incurred there. And then for a lessor, the receivable is basically the same, the present value of all the payments less incentives, and then the revenues deferred and recognized over the life of the agreement. And then variable payments are an item because it's going to show up when we do the footnotes. If your rent was tied to the CPI index or a percentage of sales, say, well, your rent's going up through the years. That was not included in the initial lease liability calculation. So you would then just go ahead and expense that variable payment, that excess payment every year. But you don't include it in this calculation. You don't try to predetermine that increase. So what events, once we've done all of this calculation and booked the thing, does everything just kind of end there? The answer is no. Certain events now will trigger new calculations on that same lease as you go forward. And that could be changes in the lease contract. It could be that the landlord, we had some of these happen during the pandemic. Landlords and companies will be able to sit back and go, hey, wait a minute, we're not using as much space and we need to reduce rent. So what can we do? Well, they kind of maybe expanded the lease out. It's the same, for more years or something, or less dollar amount per month. And so you need to recalculate it. But if you were to change the lease in the way that, hey, landlord, we need an extra 10,000 square feet, and you calculate what the rent's going to be for the additional 10,000 square feet, what you then have is a new contract to record. So that wouldn't work the same way as the previous example. Another thing that would change it is where we first kind of did our calculation, we had to look at, are we reasonably certain to exercise options? Well, initially we might say, we have this 5-year option coming up, but when we first booked it, now we're just going to book it at a 10-year lease. We're not certain we're going to go with the extra 5-year option. Well, if that changes after a couple of years, then you would remeasure your lease liability and go over the full 15-year period instead of just the initial 10 that you may have thought you were going to use it for. And when you do that, you would then go to the new current index. So like if it's tied to CPI, you would use a new CPI rate at that point. But just a change in CPI index rate would not alone cause a remeasurement. And of course, if you remeasure the liability, you got to adjust the right of use asset. And as we do with all assets, we need to consider impairment at that point in time too, because maybe this asset just doesn't have the value that we thought it might have. Now let's see, I got just about 10 more minutes maybe, huh? So let's go into now the financial statement, the presentation and disclosures. There's new financial lines to consider. We've always had what we may have, well, maybe it was buried in just equipment or forklifts. We had the capital lease in there, and that can stay the same. And of course, we had a capital lease obligation on the liability side, current and long-term. That's probably going to stay the same. But some new lines we'll have now is for the operating lease. We would have now an operating lease right of use asset, and most companies are showing that separately on their balance sheets. I'd say 70–80% are doing that. And we would have an offsetting right of use operating lease, various terms we can come up with, liability here for current and long-term on the liability portion of the balance sheet. And so basically for leases, we have 6 accounts between assets and current and long-term portions that could show up on the balance sheet. And I think it's good to be transparent with the operating leases, because you might want to pull that out separately, or the bankers may, especially when you're looking at liabilities, because it's kind of a debt, but it's not a true debt as we look at like loans and accounts payable and things like that. So bankers, I think, are going to pull that out separately, and ratios may not be impacted. And in the footnote, like I say, it's a long, lengthy footnote to disclose all the things that are involved in the leases, like the general description of the lease arrangement and terms and conditions, and any option periods, and any variable payments and residual value guarantees that were not included in the liability that flush through in various subsequent years. You're going to disclose those. And the lessees will include the lease asset and the related cumulative amortization, kind of what we did in capital leases, if you recall those footnotes. So now we'll show that as well for operating leases. And we will disclose all the major classes separate from other capital assets. And so, there's chances where we couldn't put a lot more detail in the footnote and keep the balance sheet simple. So that's something to discuss as we go forward. But and then the expenses for the year, we got to kind of break those out now. You'll have your finance type lease expense, and then you'll have operating lease expense. And if you had some short-term, less than 12 months or less type of leases, you would show that expense. And like I previously mentioned, any variable expenses we would have, tied to CPI or just unusual things that were not an initial liability measurement, we would have to show that a variable expense. And again, we'll have our future maturities by year schedule, just like we had for capital. Now we'll have a column for operating and show those for 5 years. I think we kind of had that on some of our financials, so that's not a big change. And a lessor would have to also disclose existence of debt issued secured by lease payments. And so any other commitments under leases before the end of the lease term that could come up in the initial calculation or in subsequent years, we would have to disclose that. So get ready for like a 2-page footnote on operating leases alone. And so here's a tabular kind of a presentation of just putting more of the same things I just described under lessee and under lessor. And I won't kind of go through that again for the sake of time. I want to spend some time going through this example we have coming up. But before we do that, hope I do this right. We have a polling question.
All right, thanks, Mike. Launching the poll real quick. It says, how many leases do you expect to record and track in your organization? I'm going to give you guys about 30 seconds real quick here, and then I'm going to close it out. Okay. Going. 5, 4, 3, 2, 1. All right, I'm going to end polling. Back to you, Mike.
Thank you, Jill. All right, let's go through a quick little example. So let's say a lessee enters into this following lease. It's for 10 years, the initial term, with a 5-year option, and got payments of $50,000 payable at the beginning of each year, and initial direct costs for $15,000. And we're going to say for this example that the incremental borrowing rate was used, not the risk-free T-bill rate, but they figured out it was a 5.87% rate. So to calculate this, we'll look at the payments of $50,000 for 9 years and get the present value of those, and then discounted at 5.87%. We've now got this nice little liability of $342,017. So, to bring it all home, right? Of all the things I said, here's our liability for this little 10-year lease we have. Now we would go over and figure out, okay, well, now what's the right of use asset we're going to put on there? So it's not the same number, because we had this $15,000 of direct cost, plus we had the $50,000 we paid up front at the beginning of the year when we started the lease. So you add all three of those together, and your right of use asset is $407,017 on the balance sheet. And then we need to calculate the lease costs. Now, this doesn't change from how we previously did operating leases. You just take the sum of all the lease payments, which is the 10 times the $50,000 a year, plus the $15,000 of direct cost. Again, direct cost being like commissions, or maybe you had to pay a tenant to get out of their existing lease, and so you could take it over. And so now you have $515,000 of cost. You divide that by the 10 years you're doing, because I should mention here, we had that 5-year option, but when we went through these analysis here, we decided not reasonably certain to go 15 years. We're going to probably only use it for 10. And so you use the 10 years. And so your lease expense is $51,500 per year. So here's the journal entry. We're going to debit the right of use asset for the $407,017 we calculated, credit the lease liability over the $342,017, and we spent cash, so we got a credit to cash for the $50,000 and the $15,000 of direct cost, for a total of $65,000. Then we get down to the end of the year. So what's the entry? Well, we're going to have that lease expense. That didn't change. It's the $51,500. So you might think, okay, that differs from a finance lease. You know, that where we had some interest and principal paid. So, you know, those are top loaded. Your expense is a little higher when you first enter into a finance lease, and it's less as you get to the end of that finance lease. But for an operating lease, it's flat line, straight line, just it's going to be the same $51,500 every year. And then the lease liability is $20,076 credit. That is calculated by actually taking that liability of $342,017, multiplied by the interest rate that we discounted the liability at, the 5.87%, and say, all right, $20,076 is basically the interest. So that reduces the liability by that amount. And that amount will diminish each year. And then we have this leftover number, which is, I've learned a new term, SFN, solve for number. It used to maybe be kind of thrown around in our office as a plug number, but no, not anymore. Now it's a solved for number. So the difference between lease expense and the lease liability results in $31,424, and that's the amount that will reduce the asset. So as a result, we're going to have a liability on the balance sheet after this is all done of reduced down to $321,941, and our right of use asset is decreased down to $375,593. So hopefully that kind of brings all that verbiage I went over for the first 20 minutes home to see, you can see kind of now what the effect of this little 10-year lease at $50,000 a year is going to do to the balance sheet. And then lastly, again, I had mentioned some practical expedients along the way. So here's a little summary of those. They're little shortcuts that are allowed for private companies. So there's 2 expedients that are part of the transition. And that is that the entity doesn't need to reassess any of the 3 following items. And you have to package these all together. You can't pick apart this. So you got to use all 3. And so that's whether any expired or existing contracts are or contained a lease previously, because it's assumed that those were properly accounted for in the past, and the lease classifications for any expired or existing leases. So if it was originally a capital lease, it doesn't need to be reevaluated to say, oh, it should have been operating, or vice versa. And any initial direct costs in those leases, we don't have to go back and dig that up. And the entity can use hindsight in determining the lease term. So if you're, 11 years into that 10-year with a 5-year option lease, you can, you got hindsight you can use in order to calculate what that present value is going to be, and any asset impairment as well. And then some other expedients we have is what I mentioned earlier, the policy option to exclude leases with terms of 12 months or less. And we can combine those lease and non-lease components, like I mentioned, like an auto service contract. And we can use a non-risk rate. We mentioned we're discounting payments, like the T-bill rate. And then for land easements, we do not need to reassess those under the new standard. You can pretty much ignore land easements. So I hope you found this example helpful in understanding the accounting for operating leases, and these expedients provide a positive for you. I ask that you hold your questions down to the end after we've completed the next section, which covers implementation and technology considerations. And for that, I would like to introduce Gail Gray.
Thanks, Mike. I appreciate it. Everybody, I want to make sure they can see my screen okay. You guys looking at our slide? Everything look good? Awesome.
Everything looks great.
Thank you for that. I'm Gail Gray, as Jill introduced. Most of you probably don't know me, but I am the new technology partner. I joined LSL in November with my team. So today my role for you guys is to bring you some information on implementation. Okay. Mike gave you all the wisdom that you guys need for why and how, but now we're going to talk about the nuts and bolts of implementing. Okay. So let's first talk about understanding your portfolio. So when you're going through your lease portfolio, you want to think of a couple things, and you want to think of these in the beginning. You want to, all those expedients that Mike just talked about, you want to make sure that you've looked at those and you've decided on those. You've decided on your capitalization policy. By doing all of that in the front end, you're not going to waste your time pulling through data and entering them into your whatever software you choose to use, whether it's Excel or to define all of this. The same thing with the embedded lease assets. That's one of those that Mike listed as something that you can ignore, but you do have to make those decisions at the front end and not necessarily the back end. So how are you going to find your data? What is some of the best methods that people are using? So you want to make sure whatever you use, it's a methodical approach and that you document it. You want to make, one of the things for this, when you get ready to be audited, is your auditors are going to be looking for that completeness. They want to know that you've done something and that you can assure them that you've traced through everything that you have and you've found all of the leases and you've made that determination. So you can use tools like data scraping tools, such as Caseware's Idea. LSL, we have that tool available if that's something you're interested in. You can do that by creating a data mining search on keywords, for instance, lease, rent, exclusive use, and that way there it will literally scrape through your data and pull out and run a report showing you anything that could possibly be a lease, and you can review that. Look at part of your financial statements. Your footnotes, there's most likely a footnote about your leases, and it may have explained your expected expense for the next 5 years. So you want to make sure you're looking at those numbers and comparing it to what you're coming up with for your leases, so that there's some reasonable tests going on. And don't forget to look through your general ledger. Everything may not have been coded to the proper rent expense or to a specific lease expense account. So make sure that you're looking analytically at those numbers, at the transactions, and really reviewing to make sure you've got all your leases together. Those are going to help you get things started, not necessarily establishing them all, Also take a look at defining that incremental borrowing rate that Mike talked about. You want to make sure you've got that in place. You want to make sure that you maintain a complete listing of your portfolio. So you may already have one, okay? If you already have that listing, that's great, you're ahead of the game. Make sure that you review it, that it has your renewal dates, that you're understanding all of the components of it. Gather all your lease documents because you're gonna need those. And make sure, again, I can't tell you how much I want to stress that you've decided on those expedients, that you've defined that capitalization policy, and you've defined your incremental borrowing rate. You can't calculate if something's immaterial if you're not using that borrowing rate. You can't determine if something's immaterial if you haven't defined your capitalization threshold. So you want to make sure that you've planned ahead before it's time to just start scraping data and putting it in a calculation, because you'll end up doing a lot more work than you need to. So we talked a little bit about the casework tools and the rent expense. So just reminding that you want to make sure you dig through that general ledger. So what about embedded leases? Mike mentioned that you could exclude those. It's not always a benefit to not pull that stuff out. Sometimes you want to go through it, but you want to make sure that you're looking at it and you determined it to be immaterial. So what is a little bit more on what is that embedded lease? Remember, you're looking for those service contracts that would have a lease component, that right to use of the asset. And then you're going to bifurcate it. You're going to pull it out and you're going to include that lease, and you're going to not include the service component. So that's what they're talking about with those embedded leases, just the bifurcated. You may hear that terminology. It's going to help you to be able to just pull those apart, record one as a lease and the other part as an expense. Okay. I want to talk to you a little bit about a 12-step process for implementation. This is not the end-all be-all, but this should give you guys some help. And after this, make sure you go out to LSL's website. We've got these documents up there that will really help you look at all the different components that you need to do to finish this process. So you want to make sure, like we talked about, you understand your lease portfolio. Make sure that you've done all of the work to find it and pull it together. You want to ID a point person. Somebody's got to take the lead on this to make sure that it all happens and comes together and is done timely. Don't wait till the last minute. You want to have a discussion on, are you going to use a software? Are you going to do this in Excel? And really think about what you want to do. Identify those departments that would maintain leases. So if you have multiple departments, multiple entities, multiple organizations across the country, across the international, you want to make sure that you're reaching out and you're having these conversations because those are the ones that are managing those leases. In finance, you guys may be doing all the number crunching, but you may not have all the information you need to gather together for this requirement. That's when you're going to get that listing of leased assets. So you want to start coming up with that list of assets, and you want to identify where they're at. You're going to need information from the people that are actually using the equipment. Are you planning on renewing this? Is this something that has a reasonable value? Those kind of questions. You want to send out a template out to those departments that are managing those leases and get them to get you the information that you need. Because as you can see with what Mike was saying, there's a lot of information you need. And you don't really realize that depth of information until you actually start putting it into that ugly Excel spreadsheet or into a software when it asks you all these questions about right to use, or is it reasonably expected that you're going to extend? So you want to make sure that you've really gathered all the data. Once you've got all the data and you've got it together, you want to reconcile it. Go back to what we talked about with the data extract mining and looking at financials. Reconcile those numbers. You know, you're going to be looking to see, is this reasonable? What I'm showing as these leases, does it come in line with what we showed as capital and operating leases in the past? Is it missing a lot? Is there a lot more here than we expected? And then you're going to continue to validate that completeness, and you're going to create that 5-year schedule, because you have to be able to report the expected payments over 5 years. You're going to collect details for that most recent rent expense that you've been reporting, and you're going to compare them. That's that reasonable test for rent expense we're talking about here. And then you're going to record the transition adjustments. So like Mike stated, you don't have to necessarily restate your prior. in your comparative statements, but you actually have to know that number. And so making sure that you're calculating this adjustment and then recording that information so that you have it available. Okay. So for a successful transition, you want to think of three key areas that you need. You want to think of the people. Make sure that you pull the right team together. This is not a one-man job. You're going to find as you start doing all this that it takes a lot of people's input. Implementation team, department points of contacts, people that are going to be reviewing the leases, IT and technical staff. If you're going with software, you might want to pull in some interim staff to help with the data entry. Trainers and consultants, somebody that if you need to train your department leads, you need to train the people that are going into the leases and also the AP people that are posting the leases. You want to bring trainers and consultants in. And that's where LSL will come alongside you. And you also want to determine if you are going to use a software that you've got those software decisions and the point of contact. So again, tools existing, you want to use your Excel. You're going to have current Excel. You're going to have your ERP databases, your accounting software. You might want to look at IDEA, like I said, mentioned before. Automation, there's all kinds of tools that we can use in the automation world to help automate some of these processes. Specialized software for leases and lease management. So we're going to talk a little bit about that in a minute, especially some specialized software that is out there that can really help you, and then a project management tool to make sure that you're tracking and you're completing your project on time. Under processes, like I'm going to keep telling you this over and over again because I'm coming to you guys with some experience on implementation. Document. You need to document those processes and those policies that you're adopting. If you're going to adopt a capitalization policy similar to your existing capitalization policy, or you're going to adopt different ones, or you need to determine the asset classifications for those right to use assets. You're going to train your team and you're going to document the processes. You want to plan and organize. You want to automate wherever is possible. And you want to make sure that you're reevaluating these processes over and over again. This is all new and it's something that has to happen and it's going to keep happening. And because this is the first year, it's also going to constantly change. We get a lot of questions coming at us, what's this one doing and what's that one doing? And what we're finding is that everybody's just kind of out there trying to figure their way, just like any other large change in the accounting standards. It's going to evolve. So just be aware of that. Watch for the evolution of this implementation. So what are your options? I mentioned you can do this in Excel. So there are Excel spreadsheets. In LSL, we have one. If you reach out to us, it's a complex Excel spreadsheet because remember, you're going to be doing a lot of not just calculating the present value, but now we have to have the 5-year payment schedule. We have to be able to modify it if we have lease modifications. So we're going to have to count the deferred inflows, the deferred outflows, the revenues, all the liabilities and things. So it's very complex. So you want to make sure that your spreadsheet can meet that requirement. Okay. And they're out there. You just have to find them. Don't be afraid to ask for help. Leverage on your CPA firm, leverage on LSL. We are here to help you guys. We can help you implement it. We can also, if you just have a few leases and you don't want to deal with it, we can provide you a managed service where we can actually handle the leases for you, do the calculations and give you guys what you need. But there's also an option of lease software. LSL, we are partners with Lease Query. So we are resellers and implementers and consultants with Lease Query software. And we really consider that to be a premier lease software solution. So I'm going to talk a little bit about that in just a minute. Okay, Jill, I think we're ready for our next poll.
All right, here we go. Launching poll number 2. Have you started your ASC 842 transition process yet? If not, when? We're really hoping that we don't get too many responses for number 5. We are totally not going to make our deadline, but that's why we're here, right? All right, I'll give it a few more minutes. Okay, 5, 4, 3, 2, 1. Okay, back to you, Gail.
Awesome, thanks, Jill. Okay, let me see if I can, there we go. So we've talked a lot about tools that you can use to come up with the numbers you need for your disclosures, for your balance sheets. But there's also benefits to coming together with a solid lease software to manage your leases. So I don't know about you guys, but in the past, when I've managed our leases, for my companies, it's been, okay, you sign them, they're out there, and we forget about them. And then it's like, when does that due to expire? So by using a managed lease software, it's going to give you guys a lot of additional information. You're going to be able to find your data. It's going to save you money because it's going to help you find those leases that are going to expire, that if you can extend them, or you can choose the options that are available, you're on time with that. You're going to achieve your compliance with a good tool. You're going to be ready for your auditors because you're going to be able to present them with the analytics that they need to get to the balances, and you're going to set yourself up for success. So we want to make sure that go out to LSL's website. We've got some tools out there for helping to choose a software. We've got lots of tools out there. So just reach out to us and let us know if you can't find it. But Jill's website is pretty darn awesome, so you can find lots of stuff there. Okay. So let's talk about ROI and how technology really can save. So without technology, you're going to miss the opportunities. Okay, so you want to avoid those unnecessary month-end or evergreen fees, the ones that we forget the lease that is still going and we're just paying it month to month because we've always done it that way. We don't consider whether we're even using the equipment. You're going to have better internal controls. You want to make sure that you're considering that. You're going to ensure there's accuracy in your rental payments and the escalations and the concessions and the deferrals. And you're going to get reminders to collect those refunds or any of the other information you need. So setting up a lease management is, this is a really good time to do it if you haven't already got one in place. Okay. Control environment is also real important. Being able to separate your duties, have someone to enter a lease and have someone review a lease is critical to making sure that you get everything set properly. You can have department heads entering leases, or departments, not the heads, of course, entering the leases, but you have your departments entering the leases, and then finance can come behind them and review them and approve them. Gives you the ability to track changes. So Mike talked about modifying a lease and going in and reevaluating or refiguring out the incremental borrowing rate. You want to make sure you're tracking that because you have to maintain the integrity of the prior data and why you're creating this journal entry to change it and bring it up to the new balances. And then we talked about department. So you want to consider when it's in time to forget about that Excel file and switch. So there's a lot of things to consider because Excel is great. We all love Excel. It can do amazing things, but we all also know how hard it is to maintain, for instance, fixed asset lists with ever-changing balances and ever-changing staff. So you want to think ahead on that if you've got a lot of leases to really be careful. Excel can't give you guidance. So if you're not 100% exactly sure, you want a strong software that can guide you, that no, this is, if you answer it this way, it's got to be this. Okay, so you want to look for a software that can do that. Collaborative database. Multiple people can enter leases from multiple departments, multiple areas across the country, whatever you need. And then a good lease software should be able to generate all those journal entries and disclosure reports that you need for your reporting. Okay. Software and a service. So like I mentioned earlier, LSL can come alongside you guys. There's purpose-built technology, purpose-built lease software. Then you want to make sure that that's what you're looking for, not a software that's kind of thrown it in on the sideline. Make sure it's a good software. Like I told you, we mentioned that we are resellers with Lease Query. That is not the only lease software that's out there. Okay, there are multiple lease softwares out there. Look at their history, look at how long they've been around. Make sure that they give you all the pieces you need. Okay, so you want to make sure you're getting those amortization schedules, the journal entries, the disclosure reports, giving you what you need for those comparative statements and helping you to manage your data. And then it's going to be easy. So just make sure that you really thought about that before you jump out there and get into one or the other. Okay, there's your poll question, Jill.
All right. Poll question number 3. Would you like a demo of Lease software? If so, when? All right, third of the fourth poll. Okay, gonna give you about 15 more seconds here. All righty, I'm closing poll. Back to you, Gail.
Thank you. Okay, so we have pretty much come to the end of the presentation. I hope you guys have gotten a lot out of it. We know that there's going to be lots of questions, and if we can't answer them all today, I know we'll get to you guys. So Jill, I'm going to turn this over to you.
Okay, so we do have quite a few questions in the Q&A box. Probably don't have time for all of them, but Gail, Mike, do you want to just scroll through, and I'll leave it up to you two to grab which ones you want.
Yeah, sure. That'd be great. Yeah, a couple of these hit on some things I wish I had kind of mentioned along the way that for this is only for GAAP financials. So if you're currently, doing a cash basis, tax basis, or other method of financial reporting, you don't need to comply with this financial standard of accounting for leases. So that's a good question. And sometimes I throw out there, we have this other new reporting framework that is what I call small GAAP, and it's called financial reporting for small to medium entities, which are basically any non-public company. And so it's not that small of an entity. And you can, you don't have to record deferred taxes or investment fair value or this lease standard, as far as I know, under that reporting framework as well. So that's an option, although your bank would have to say it's okay in their lending agreement for you to give them a non-GAAP financial. So that's the first talking point to have with the bank. Someone asked a good question too. If the asset and the liability are the same number, why are we doing this? Well, that's a good question because it gets back to why this standard was issued in the first place. And it's all about transparency. They found that operating leases weren't fully disclosed in the footnotes. And even if they're in the footnotes, not everybody can see everything with the data, the way data extraction techniques and bots and everything else pull out financial from a balance sheet. It's hard to pull those numbers out of a footnote. So by putting it up on the financial statement, the bankers can see what those future cash flows are going to be and what the obligations truly are of an entity. So in that regard, it made some sense. Somebody else also asked about lease guidance, like when I said we don't have to do it for the prior year, like for 2021, we don't have to change that accounting, just change it for 22 and go forward. What are the banks thinking about that? And that's kind of interesting. I don't know if we have any bankers in the call, but the bankers that I've talked to that I bring this up with kind of like look at me with big bright eyes, like, what are you talking about? What do you mean you're going to put this liability for operating leases on a balance sheet? So there's a lack of information out there. So kudos to everybody here that's listening on the webinar to get the information, and we'll try our best to educate bankers as well. But I don't think bankers are going to have a problem with that, because you originally issued that 21 financial recently that way, and they're not going to want to see that it changed. That makes their life a little more complicated when they do the ratios. So they'll understand the footnote what the new adoption was and look at 22 going forward. And I think that's everything I have so far. Is there anything else there? Liz asked, there's a sample list of equipment, software, and other items that I can share with other departments that would help trigger missing leases, if any. Yeah, well, that's a pretty simple. I mean, it's company by company. Not everybody has forklifts. Not everybody has certain things, but everybody has a copier. So yeah, you probably put that out there to all the different locations, saying, hey, give me a list of the copiers. And if they were independently signing leases, then they would have to give you the lease documentation or send over the lease document. And I know, Gail, you didn't talk too much about that, but we have some technology. I don't know if you want to share about how it can scan through a stack of 100 leases and pull out the data and save yourselves maybe a week of reading through these great documents that could put you to sleep. You want to talk about that, Gail?
Absolutely. So we are in the process of developing an RPA machine learning bot. His name is Jarvis. Jarvis is similar to an AP bot that is used to read through invoices and post invoice information into your ERP system or your accounting system. So Jarvis is being trained to read through the leases and extract out the lease information and enter it in an Excel spreadsheet or lease software. So we're real excited about launching Jarvis. So if you want more information on Jarvis, please reach out to us. We would love to share with you even just on RPA and what it's about. The other thing that I wanted to mention, Mike, when we were talking about the lease classification is, and going back to the departments on what are equipment leases, is I just want to keep reminding you guys, before you start reaching out to those departments and asking them for stuff, define your policies. Make sure you know your materiality. Make sure you understand because what you want to do is be able to be concise in what you're looking for and make sure that you explain that to your department. So if they're looking at a postage machine that's got, $10 a month for X amount of months, that may not necessarily be quite so as important. To kind of keep everybody from having to scramble and pull a lot of stuff together. So make sure if you need help with those policies, Mike's team is definitely here that we can help you get those policies updated and drafted for you. So that's also something that you don't jump past it and just jump to the end. I can tell you how much time we've wasted forgetting to do all of the little pieces, because when you get ready to enter the information in Excel or in your spreadsheet, you've got to know this information. So.
Yeah, and in that light, that's some experience that we've seen from the public companies that have been doing this a couple of years, and even some of the privates that they thought they had their arms around it. And it's just amazing once you start scouring through some of the details of, disbursements listings or talking to different departments, the number of leases that just pop out of nowhere. And that's kind of one of those benefit things that Gail had talked about too, that man, you start to see, wow, I didn't know we were still paying for that XYZ lease. We haven't used that asset in 10 years. What have we been paying that for? And, some of these things just keep reoccurring. They fall under the radar. So,
I love the one, Mike, I love the one where they say, well, we've been paying on this lease for 30 years, but it's just month to month because we've never rewritten the contract. So what do we do? What do we use? And so there's a lot of that stuff coming out, finding things. So they're trying to redetermine and reevaluate those kind of things. So it's been fun. We've been getting lots of cool questions. So anyway, I just thought I'd remind people of those too.
Yeah, I think that's been a positive of this. I mean, it's overwhelming. It takes a lot of time. I got to get back to that. Like you said, we got to document your process, especially if you're having an audit. The auditors are going to jump in no matter who your firm is. And that's the first thing they're going to ask is, show me your listing, show me your policies. Did you elect this expedient, or what interest rate did you use? All sorts of decisions go through this whole thing. And so you got to document those, especially if you're doing an audit. Nice if you're doing a reviewed financial statement as well. And I'm kind of leery of what are we going to do in 2022 when we start doing financials for clients and they tell me, I haven't created that footnote. We haven't even looked at this thing. So can you do that for us? Well, not in 2022, we can't. So that financial is not going to get issued. We're going to have a gap departure paragraph. It just takes much more time than we all think. And that's been the experience that public companies have seen. And even after 2-3 years, they're still finding problems and issues and adjustments. So, materiality can kind of come into play with this. And we can also talk about capitalization policies. You could have a set capitalization policy that says we don't capitalize anything under $10,000. And maybe you have some small copier leases that they'll never get over the 10,000. So you don't have to worry about this. But, the big building leases, of course, those commercial leases, I think we had a question on that. A commercial lease is a big number and that does need to get recorded. Even if it's with a related party, and if they're month to month, you shouldn't have month to months, informal agreements, because what if something happens to an owner? Are you at the whim of the trust or some families down the road? You kind of want to get these things documented and know that you have some solid lease agreements. So I'm not saying I'll make them long term, but something that's a little more substantially documented so you can have the trail you need.
Okay, with that, we are at the top of the hour and it is time to launch our fourth and final poll. So here goes. Are you interested in using outside consultants to help you with your lease implementation process? I will leave that up for just a moment. And then I will let you, Gail, close it out for us.
Okay, thank you guys. So we really want to say thank you for showing up and taking the time to come and listen to Mike and I. We're here if you need us. Remember, you can contact LSL, reach out to our website. You can email info@LSL CPAs. Please remember to take the time to let us know if there's anything we can do to help you guys. Thank you so much for coming.
Great, and keep in mind, we're going to be sending you out some helpful information later today, so be on the lookout for that in your inbox. And if you are getting CPE, remember to fill out the brief survey coming from Prolera. And with that, I want to let all of you go, and thank you so much for coming. Have a great day, and we'll talk to you all soon. Bye-bye.